Okay, let's unpack this. For years, maybe a decade now, there's been this incredibly fierce, almost religious civil war going on
Oh, yeah.
in the world of sound money. You've got the gold bugs, the traditionalists squaring off against the Bitcoin maxes, the revolutionaries.
And both sides are absolutely convinced they have the only answer.
Exactly. The only hedge, the only lifeboat against, government money printing. And the noise online, frankly, it's just deafening.
It is. The tribalism completely drowns out the signal.
Yeah.
And that's exactly why we're stepping in today. Not to pick a side,
No.
but to act as, let's call them, forensic investigators.
Yeah.
We have to strip away the emotion, the price charts, all of it, and just look at the pure hard facts,
Yeah.
forensic physics, and the mathematical properties of these two things.
A clinically objective approach.
It's the only way.
And that forensic mindset is so important because our mission here is really simple, but it tackles, I think, the biggest problem in finance. How do you as an individual store your labor, your time, your energy, your future? How do you store that in something that a government can't just leak away or debase or just take?
And asking that question, that core investigative question, it completely reframes the whole thing. Gold and Bitcoin, suddenly they're not enemies.
Right.
They're allies.
Yeah.
They're fighting the same war against the same structural flaw in every fiat currency on the planet.
And this is so crucial for everyone to understand.
It is. Gold and Bitcoin are the only two assets, really, that are not someone else's liability. Every dollar in your bank, every bond, every stock, it's a debt. It's a liability owed to you by a government or a corporation.
You're just trusting them to be solvent.
Yeah.
And to be honest.
Gold is what we'd call analog sovereignty. It's a physical fact. It exists outside the system. And Bitcoin, that's digital sovereignty. It's a mathematical fact.
Okay, so they're the only two independent reserves available to, the average person.
Yeah.
And that, right there, that's the key premise for this entire deep dive. They're trying to do the same thing, protect you from fiat currency, but they use completely different technology to get there. It's atoms versus bits.
Precisely. So that's what we're going to do. We're going to compare 5,000 years of trust, of human consensus baked into gold.
A very long time.
Against 15 years of absolute mathematical certainty in Bitcoin. We're going to look at the trade-offs piece by piece and then show you why the smartest, most non-ideological investors, the smart money, they aren't choosing a side.
They're diversifying.
They're diversifying into both, strategically.
That sounds like the only playbook that makes sense right now. Let's start the investigation. Let's open the file on the incumbent, the ancient champion. Okay, here's where it gets really, really interesting. When you talk about gold, its primary weapon, it isn't the shine, it's not its density, it's time.
It's the Lindey Effect.
Explain that.
The Lindey Effect is a really profound idea.
Yeah.
It basically says that for things that don't have a natural expiration date, like an idea or a technology, the longer it's already been around, the longer you can expect it to be around in the future.
So its past predicts its future.
In a way, yes. And gold has been used as money, or at least a store of wealth, for 4, maybe 5,000 years.
And that track record, it's not just some historical footnote, is it? It's its most powerful security layer. I mean, think of the stress tests gold has passed. It was money in Babylon 4,000 years ago. It was the foundation of Roman currency. It survived the fall of Rome, the Dark Ages, the Industrial Revolution, 2 world wars. And it has survived the collapse of every single paper currency ever invented by humanity in that time.
That historical consensus is the very definition of deep, immutable trust. The social cost to just decide gold isn't valuable anymore is. It's just too high. Because when everything else fails, when a government's paper becomes worthless, people instinctively know they can fall back on the shiny yellow metal.
The trust is baked in. It's not a promise about the future.
It's a fact of the past.
But doesn't that make it sound a bit like a relic? I mean, central banks have been selling some of their gold. We live in a digital world. Does that Lindey effect just eventually run out of steam?
That's a fair question, but Lindey applies to its survival as a concept of value, not its use for, buying coffee. Its survival is all down to what I call the physics of sovereignty.
The physics of sovereignty, okay.
It comes down to its material science. Gold has 3 qualities from the periodic table that just make it the perfect battery for storing value across centuries.
Like, what are they?
First, it's chemically boring. It's inert. It just refuses to react with almost anything. It doesn't rust like iron. It doesn't tarnish like silver.
So it's immutable.
It's immutable. An ounce of gold today is chemically identical to an ounce of gold 1,000 years from now. You don't need electricity or software updates or a password to just keep it existing.
The ultimate zero maintenance battery? I like that.
Second, its color and density make it really hard to fake and easy to test, at least, historically. That helped build consensus early on.
Okay, and the third quality, the one that links back to sovereignty.
That's its rarity, which gives it a super high value-to-weight ratio. So while it's heavy, you can hold an immense amount of purchasing power in a small coin or bar. That makes it portable enough.
When you absolutely need it to be.
Exactly. And those properties together, that's what defines its analog sovereignty, its value that is completely detached from the digital world.
So this is the apocalypse asset scenario, the ultimate defense against a total system failure.
Precisely. You have to consider your threat model. Today, almost all our wealth bank accounts, stocks, it's just numbers on a server somewhere. It depends on the grid, on the internet, on satellites.
And what if that all goes down? A solar flare, a major cyber attack?
In that specific, terrifying threat model, the day the grid goes dark, gold is the last thing standing. It's still there. You can hold it. You can trade it. It can't be digitally erased.
The sources have this really powerful example to ground this idea.
The Roman coin.
Yeah, talk about that. If you buried a gold coin, an aureus, in 100 AD.
Yep, at the height of the Roman Empire. Back then, that coin could buy you a very fine suit of clothes, a toga, a tunic, sandals, or maybe a decent horse.
And if you dug that same coin up today,
that same weight of gold can still buy you a very high-quality tailored suit. Or, maybe a reliable used car. The point is preservation.
Not appreciation, preservation.
It's about storing your labor, your work, across 2,000 years, and having it hold its value while every single paper currency in between went to zero.
Okay, so that highlights the trade-off. Gold is heavy, it's a pain to move. Verifying it can be tricky. It needs a secure vault.
Yes, those are the physical burdens.
Yeah.
But in exchange for that, you get absolute trust in its physical reality. Its value can't be turned off with a switch. It's the ultimate zero counterparty physical thing.
And central banks still know this, right? That's why they hold it. It's the only zero-risk asset on their balance sheet.
Because it has no counterparty liability. If China holds U.S. bonds and the U.S. defaults, those bonds are worthless paper. But if China holds physical gold, that gold is still gold. Its value doesn't depend on America's financial health.
So gold is the defensive anchor, the shield. It's for preserving wealth and ensuring against a total system collapse.
It's the low volatility, high trust foundation.
Sure.
But even this 5,000-year-old champion has a flaw, a chink in its armor.
And what is that?
And that flaw is precisely what Bitcoin was designed to fix.
All right, let's pivot the investigation. Let's look at the challenger, because we have to talk about that critical flaw in gold. It is not absolutely scarce.
This is the forensic crux of the whole debate. When gold bugs talk scarcity, they're talking about how hard it is to mine new gold. And it is hard. It's expensive.
Right.
But difficulty is not the same thing as a hard, verifiable, absolute limit.
And the sources really hammer this home. The supply of gold is ultimately elastic. It responds to price.
Exactly. Imagine gold isn't $2,000 an ounce. Imagine it's $20,000 or $50,000 an ounce.
The incentive to find more would be astronomical.
It would be revolutionary. Human ingenuity, fueled by that much profit, would invent incredible new extraction tech. Places we can't get gold from now. The ocean floor, the Earth's mantle suddenly become profitable.
And then there's the sci-fi scenario.
Asteroid mining. It's not science fiction forever. The point is, the possibility of a supply shock that could dilute the market is not zero. So the supply can always inflate, even if it's slowly.
Now, the gold community often talks about the stock-to-flow ratio. They say the new supply is tiny compared to what's already out there. They even use this term triple halving rate to compare it to Bitcoin.
Right, and it's a useful model, but it has a flaw. The triple halving idea just means that new gold mining adds about 1.5% to 2% to the total stock each year.
Which is a low inflation rate, similar to Bitcoin's after a few halvings.
Exactly. It's what gives gold its hardness. But, and this is the critical distinction, that rate depends on technology and price. If we invent a new way to get gold cheaply, that flow rate could spike. It could double or triple. It's subject to human discovery.
And that's where Bitcoin comes in. It fixes that specific flaw.
It defines absolute scarcity for the first time. Bitcoin has a purely mathematical supply cap, 21 million, full stop. That number isn't set by geology or economics, it's coded into the protocol. It's a constant.
And it's important to explain why that number is basically immutable. It's not like a central bank policy they can just change. It's enforced by a global, decentralized consensus.
Right. No matter how high the price goes, no matter how much energy you throw at mining it, the supply cannot, mathematically, go past 21 million. It relies on the immutability of code, secured by proof of work.
But people ask this all the time. Why couldn't the miners just get together and agree to change the cap to, say, 42 million and double their money?
Because the moment they try, they create something called a hard fork. The network splits. And the vast majority of users, exchanges, businesses, all the people who hold Bitcoin because of its scarcity, they would just keep following the original 21 million rule set.
They would stick with the scarce version.
Of course. The new inflationary chain, the 42 million coin, would instantly be seen as diluted, inferior, its value would crash. Any miner who supported it would have just made their billion-dollar mining rigs worthless because the coin they're mining is now worthless.
So the economic incentives are perfectly designed to punish anyone who tries to inflate the supply.
It's ruthlessly enforced by the market itself, not by a government. That's the guarantee.
So gold is physically scarce. Bitcoin is provably and absolutely scarce. That's a huge distinction.
It's a philosophical leap.
Yeah.
But beyond scarcity, Bitcoin brings another property to the table that gold just can't match because of its physical nature, and that is high-velocity portability.
The ability to teleport value.
Yes, money that moves at the speed of light.
Let's really paint a picture of this. The portability problem is a huge deal for people with wealth.
Okay, contrast the two. Let's say you need to move $10 million of physical gold across a border. You're trying to flee an oppressive regime, whatever.
Right.
You need armored trucks, security guards. You have customs, declarations, taxes, and the very real risk that the government just takes it. It's an immense physical and logistical nightmare.
Your own assets become a prison. They chain you to a location.
Now, the Bitcoin scenario. You can take a 12-word or 24-word seed phrase, just a string of simple words, and memorize it.
Put it in your head.
Put it in your head. That phrase is the master key to your entire fortune. You can walk across any border with nothing in your pockets, find an internet connection, and instantly access and control all of your wealth.
You are your own bank, capable of moving immense value with zero weight and zero permission. For people facing capital controls or persecution, that's not a convenience. That's a lifeline.
And that portability is why Bitcoin is the offensive line. It's built for speed, for access, for resisting control in a digital world. It's internet-native money.
So the contrast is incredibly clear. Gold is the asset for when the internet fails. Bitcoin is the asset for when governments fail, but the internet is still on.
So now that we've laid out the core properties,
Yeah.
gold's time and physics versus Bitcoin's math and speed,
Yeah.
what's really fascinating is that the choice between them isn't about which one is better in a vacuum.
Right.
It depends entirely on your personal threat model, your time horizon,
Yeah.
your risk tolerance. There are different tools for different jobs.
We have to synthesize the data objectively. So let's look at the three big variables for any store of value: stability, confiscation risk, and auditability.
Perfect. Hashtag A. Stability versus volatility.
Okay, let's start with the big one. The gold bugs always hammer Bitcoin on its volatility. And, they have a point.
It's a justified critique. Bitcoin can swing 10% in a day, easily. Gold, in dollar terms, moves like a glacier.
So we use an analogy for this.
Yeah, gold is like a supertanker or a cruise ship. It's massive, it turns very slowly, it's stable. And that stability is a huge advantage if you might need that money in the next 6 months. The risk of a big loss is minimal.
That stability is comforting. It's easy to hold emotionally.
Right. Bitcoin, on the other hand, is a speedboat. Or maybe a fighter jet.
Chuckles.
It's incredibly fast, super volatile, and it throws you around like crazy. And that volatility is real. It's because it's so young, it's a much smaller market than gold, and it's still in its price discovery phase.
But if we're being forensic here, we have to ask, what does that volatility look like if you just zoom out? If you're holding for 10 years, does that daily noise even matter?
That's the critical question. Over a 10-plus year horizon, those huge daily swings, they start to just look like noise on top of a very powerful long-term growth trend. Gold offers preservation. The slow, steady ship. Bitcoin, because of its scarcity and network effect, offers asymmetric upside.
The volatility is the price of admission for that potential growth.
It is. Gold has almost never had a 50% drop in dollar terms. Bitcoin has had multiple 80% drawdowns. The risk is completely different. If your goal is safety for the next few years, gold is the easy choice. If your goal is wealth acceleration over the next decade, you have to be willing to stomach that volatility. #TagTagNAB, confiscation risk.
Okay, this is a huge one. It's physics versus information, state power versus individual freedom. Gold is physical. That means it can be physically taken.
And history gives us the perfect, terrifying example of this, even in the U.S. Executive Order 6102.
1933 FDR.
Yep. President Roosevelt basically made it illegal for U.S. citizens to own gold. You were forced to turn it in to the Federal Reserve for a fixed price in paper dollars.
That's a devastating proof point. It shows that if the state knows you have it and can get to it in a safe deposit box, a vault, they can take it.
Its physical nature is its strength, but also its critical weakness. Now contrast that with Bitcoin. It just sidesteps the problem because it's information.
It's an idea in your head.
It's an idea. It can be encrypted, hidden, split up. How do you confiscate a memory? Or a phrase etched on steel plates buried in 3 different countries?
You can't. And not without, coercion, but there's a big counter trade-off here that people miss.
Yes. While Bitcoin is harder for the government to seize, it's much, much easier for you to accidentally lose.
This is the personal responsibility burden. It's huge.
It is. If you forget your password, if you lose your seed phrase in a fire, that wealth is gone forever. It's cryptographically sealed away. This happens to people. So you're trading political risk for personal execution risk. Gold requires you to trust institutions a little. Bitcoin requires you to have absolute, flawless trust in yourself. #TagTagC. Auditability and verification. This point for me is the most intellectually interesting one. It's about who you trust and why. Is it human accounting or is it mathematical proof?
Let's start with gold. Can anyone right now verify the total supply of gold in the world?
Absolutely not. We can estimate. Geologists guess there's about 200,000 metric tons above ground. But it's all based on reports, estimates, faith. There's no global open ledger.
And the implications of that are huge, right? Especially when you're talking about places like Fort Knox.
Exactly. Fort Knox holds a huge chunk of the U.S. gold reserve. It hasn't been properly audited in decades. When you buy a gold ETF, you are trusting a custodian, an auditor, a government agency to tell you the truth that the gold is actually there.
You trust the atoms, but you have to trust the accountants.
Yes. Bitcoin completely flips that model on its head. It offers real-time auditability. The entire ledger, every transaction, the total supply is transparent and distributed across thousands of computers worldwide.
And the key is anyone can run that audit. You, me, anyone listening.
Precisely. You don't need a special clearance. You can download the software, run a node on a cheap laptop, and in about a day, your computer will have verified the entire history of the network. It mathematically proves the total supply and confirms the 21 million cap has never been broken.
So instead of trusting an official statement, you can verify the mathematical reality yourself. No third party needed.
That's the core innovation. Gold offers physical security, but requires human trust. Bitcoin offers mathematical security, but requires zero trust. 2 completely different technologies solving the problem of trust in 2 different ways. So if we connect all this forensic analysis to the bigger picture, you can see why the fighting between gold bugs and Bitcoin maxes is just a distraction.
It's totally missing the point.
The smart money family offices, hedge funds, they figured this out a while ago. These 2 assets aren't enemies. They're allies against a much bigger enemy.
Fiat currency debasement.
Exactly.
And the data on that is just brutal. Since the Federal Reserve was created in 1913, the U.S. dollar has lost, 98% of its purchasing power?
19%. That's the real opponent. The fiat system is designed to leak value over time. And gold and Bitcoin are the only 2 real escape hatches that have emerged. One ancient and proven, one modern and mathematical.
So the smart money isn't choosing one, they're choosing both.
They're choosing both because their weaknesses actually complement each other. It's an allocation strategy designed to cover all the bases.
It's like building a sports team for your finances. You need defense and you need offense.
That's the perfect way to think about it.
So gold gets the job of the defensive line. It's your insurance policy.
Right. If your biggest fear is a true black swan event, a world war, the grid going down, total system failure, you need the analog sovereignty of gold. It's the asset for when the lights go out.
So for that, a typical allocation might be, 10%, 15%, something foundational?
Something like that. A modest but critical piece focused purely on preservation and surviving the absolute worst case.
And then Bitcoin is your offensive line. It's the growth engine.
This is for if your biggest fear is missing the next great technological leap in money, if you believe its superior scarcity and portability will keep capturing value, You need exposure to that asymmetric upside.
And because of the volatility, that allocation is usually smaller, right? Maybe 3 to 7%.
Often, yes. A smaller, high-conviction bet designed to capture that exponential growth as the network matures.
So the smart money playbook for the next decade is really a ceasefire. It's a unified strategy for the sovereign individual.
And it's a very clear three-step process.
Okay, what's step one?
Step one, own physical gold, actual bullion or coins, held securely outside the banking system if possible for insurance. You own the physics.
Step two,
Own self-custody Bitcoin. Get a hardware wallet, protect your seed phrase, learn how to be your own bank for growth and freedom.
Right.
You own the math.
And step three, this is probably the hardest one.
It requires the most discipline. Ignore the noise and rebalance. The market will constantly tempt you to sell one to buy the other at the absolute worst time.
Don't chase performance.
Don't do it. Maintain your target allocations. If Bitcoin has a huge run and becomes 15% of your portfolio, you sell some and buy more gold to get back to your targets. You sell high and buy low between two non-correlated assets. The goal isn't to be a maximalist. The goal is to be a sovereign individual.
And sovereignty requires both a shield of gold, the protection of physics, and a sword of code, the certainty of math.
And ultimately, the choice comes down to what you're betting on. If you hold gold, you're betting on physics and history. If you hold Bitcoin, you're betting on math and the future.
And if you hold dollars, you're betting on politicians, which, given the 98% track record, seems like a risky bet.
It raises a final important question about the real cost of securing these monetary networks. #outro.
So this forensic investigation, it really reveals that these two assets, they're not competitors. They're complementary defenses against the fundamental weakness of paper money. Sovereignty today really requires both.
It's undeniable. Gold and Bitcoin are designed for different threat models. The smart strategy is to use both. Gold is the stable anchor, and Bitcoin is the potent high-growth hedge.
But that deeper dive, it forces us to look at the hidden costs. We've talked about physics and math, but let's end on the real-world resources needed to secure these assets.
Yeah, this is important. When you look at the huge amount of energy Bitcoin's proof-of-work network uses, critics immediately call it a bug or a terrible waste.
It's the #1 criticism you hear.
It is. But the forensic analysis has to consider the other side. Proponents will tell you that immense energy use is a necessary feature.
Necessary why?
Because that massive verifiable energy burn is what makes the 21 million cap unchangeable. It's what provides the security, the censorship resistance. Without that real-world cost, the scarcity isn't secure. The network is vulnerable.
And that forces a really provocative final comparison for our listeners to think about. How does the cost of that digital security of Bitcoin's electricity usage compare to the environmental and human cost of securing the physical gold supply?
Gold mining involves moving mountains of earth, destroying habitats, using toxic chemicals like cyanide. And the human cost, the dangerous labor conditions, the fatalities in mines, is enormous and ongoing. Bitcoin security is an electrical cost, one that's increasingly moving to stranded and renewable energy. Gold security is a massive physical, environmental, and human cost dug out of the Earth's crust.
And that trade-off between securing value with math and electricity versus securing it with physical excavation, that's the final ethical and economic question that we have to leave you with.